Hello learners, hi, how are you all guys? I hope you're all doing good. You might have already seen part 1 to this video wherein we've discussed question number 1 and question number 2 of CA Intermediate Advanced Accounting May 2022 solution discussion. So you are right now in lecture 2 or part 2 wherein we're going to discuss solution to question number 3 and question number 4 of our CA Intermediate Group 2 Advanced Accounting solutions. May 2022 question paper solutions. Got it? So before we look at question number 3 and 4, the announcement here is with regard to the batch for November 2022 CA Intermediate Examinations. We are launching 100% comprehensive English batch on the platform of Unacademy from the team of Patience Academy. And you get to learn economics from Shan sir, FM from Dhananjay Bhave, and EIS from Rugesh Madlani sir, and Karthik Iyer sir will be handling your audit, Ravikant sir will be handling your accounting standards, Meeta ma'am will take up your strategic management, I and Mayur Naka sir will be co-handling your advanced accounting paper. The schedule for the first 2 months is here. Schedule for September and later will be updated to you all very soon. So what are you waiting for? Take up Unacademy's iconic subscription, which is a flagship model, and join us in this learning of CA Intermediate, and let us help you in this journey. You know the advantages of Plus. You get live interactive classes, recorded backup available, one subscription giving you access to all the educators' notes. But with the iconic subscription, you get hard copy of your material at your doorstep, one-to-one doubt solving sessions, one-to-one live mentoring sessions. All of this will come in to help you understand the subject better and perform well in the examinations. So what are you waiting for? If you have to take a subscription, you can choose iconic. 24-month subscription comes at a cost of 62,000, a 12-month subscription costs 38,250, and a 6-month subscription costs you 30,000. And use the code YESHASLIVE to get 10% off on the price that I just showed you on the screen right here. This is with regard to subscription which you can take up to let us help you in learning CA Intermediate Group 1 Group 2 Accounting in the detailed structured manner for the upcoming examination. Now let's get back. Here is the question paper of May 2022 examination. If in case you don't have the question paper, you can download it from the ICA website, or this is the solution sheet that I'm using, Excel sheet. In this sheet, I've provided you the link. Click me. If you click on this link, it will give you the PDF of the May 2022 question paper. Yeah, I'll share this file with you people on Telegram, and I'll also put a link to this in the description to this video. Chalo, fantastic. So in the first part, we've done accounting standards and amalgamation. Let's now start with consolidation of balance sheet and financial statements of NPA as a question. Got it? So what is it with regard to consolidation? The question number 3 on your screens now. You're done with all of these? Yeah, there we come. White Limited acquired 2,250 shares of B Limited. So this is a holding company holds 2,250 shares in the subsidiary company. On 1st of October 2020, summarized balance sheet of both the companies are given. On the same date, 31st March, so it's all peace. No need of updation, we can straight away go for consolidation. Come to the last line, what have they asked? You are required to prepare consolidated balance sheet of the group as per Schedule 3 with proper disclosure and perfect notes to accounts and detailed working notes for everything. I'm going to give you the solution. Chalo. Let's start. So the fact that we've established is White Limited is the holding company and Black Limited is the subsidiary company. So let us start with the first item. So what will we start with? White Limited's capital of 6,50,000 will appear straight away in the balance sheet of the White Limited. Have a look. 6,50,000 will appear exactly like that without any corrections. No problem whatsoever. However, when you come to Black Limited's capital of 3 lakh, this has to be split into 2 parts. This has to be split. This is 3 lakh rupees of shares of rupees 100 each. So if I split this, I would basically get 3,000 shares, of which 2,250 shares are held by White Limited and balance 750 is minority interest. Yeah, let me do that. So this is my balance sheet. All these items are not filled yet. Assume that they are not filled. I would bring you down. Notes to accounts also will do later. To working note number 1. So wherein we're going to discuss share capital of Black Limited. I'll write share capital of Black Limited 3 lakh rupees, which is made up of 3,000 shares of rupees 100 each. Of this, 2,250 shares are held by White Limited, which comes to 2,25,000, and minority holds 750 shares, that comes to 75,000. Based upon this, I'll compute the percentage of holding. 2,25,000 divided by 3 lakh or 2,250 divided by 3,000 will give us 75% and 25%. So holding company holds 75% of the shares in the subsidiary and the minority holds 25%. Remember this percentage because this percentage will help us in apportioning pre as well as post acquisition reserves between holding company and minority interest. So we're done with this also. I've analyzed it. Reserves and surplus. Reserves and surplus of the holding company 60,000 and 1 lakh 50 will appear exactly in the balance sheet. Have a look. I'll show it to you in the notes to accounts. First notes to accounts number 1 is reserves and surplus. General reserve and P&L account 60 and 1 lakh 50. See here 60, 1 lakh 50. These two have exactly appeared how it is there in the balance sheet of the holding. Same way it's appeared here. These two items will come by working note. I have not explained them to yet. I'll explain them. But right now what you need to note is these two have been thought for. Or what I'll do is whatever I have thought, I'll fill a color here to make you people understand. So general reserve and P&L account, you understood how it came. And here though you understood this entire thing. So this much is done for. Done. So next, subsidiary is 30,000. This doesn't exclusively belong to holding company. A part of this belongs to holding, part of this belongs to subsidiary. So this 30 and 90 needs to be split between holding and minority. But before we split between holding and minority, we have to split it as pre and post. Because though in the books of minority, there is going to be no impact for the pre-acquisition profits and post-acquisition profits. But in the books of holding company, the treatment of pre-acquisition profits and the treatment of post-acquisition profits are quite different. They are definitely not the same. Pre-acquisition profits are capital in nature. They will be adjusted against the cost of control, cost of investment in cost of control to find goodwill or capital reserve. However, post-acquisition reserve share of holding company will go to balance sheet, reserves and surplus. Got this? I hope you'll all remember this point. Chalo, let us get going now. Let me see 30,000 and 90,000. Let us understand as to how much is pre and how much is post in this. During the year, okay, this adjustment will come later. Yeah. Here is the point. See. The balance of reserves and profit and loss account as on 1st of April was as follows. We want it for Black Limited. Black Limited reserves was 30, P&L was 10,000. Loss on the date of acquisition. So what we would do on totally on the closing date it is 30 and 90. Now this 30 I will split. Have a look. I will come to analysis of reserves. So I will write here 30,000 is reserves. Out of that entire 30 is pre. Oh, is it entire 30 pre? It is even entire 30,000 pre. So entire 30,000 if I write it as pre, post will be 0. 30,000 is there on the balance sheet date, consolidation date. On the date when they acquired, somewhere around 1st of October or some date. On that day also it was 30. So there is post-acquisition reserves are 0. However, on the closing date or on the balance sheet date, profit and loss account is 90,000. So I'll write here 90. Of this, pre-acquisition reserves is 40,000. Is it so? Sir, but we have 10,000 loss. I think there is some adjustment. Some adjustment that I might have done. No, forgot. Give me a moment. I'll tell you what was that. Any other adjustment? Any other item to be adjusted? No. 90s of Black Limited. This is sold to White Limited for 39,000. Transaction being completed on 30th of March. Value of investments, nominal value, shares, Tara. Profit during the year 2021 was earned evenly. The point is profit during the year is earned evenly. So when the profit is earned evenly, what we would do? We would split it based on the months. Am I right? So how many? What is the date on which this acquisition is happening? It's happening on 1st of October. Then we would have to split it equally. If we split it equally, it will become like then 10,000 is lost. 10,000 loss is on 1st of April 2020. So after the 10,000 loss, what we've earned after that will be 1 lakh rupees. Now that 1 lakh rupees has to be split between both pre and post, 50-50. So here we'll have minus 10 plus 50. So it's become 40 and here it is 50. You didn't understand? 90,000 is it is on the closing date. On the opening date it is minus 10. So during there 1 lakh rupees is earned. Do you agree with me? Opening P&L minus 10, closing P&L 90. So during there you would have earned 1 lakh rupees as profit. They are telling profit is to be split equally over the period. It is earned equally over the period. So when the acquisition is happening on 1st of October, so 9 months, April to September is 6 months. Sorry, April to September is 6 months, and October to December is again. One moment. Yes, back. The power went off and the light had a little trouble. I had to fix that. So what I was mentioning is, in the beginning of the year, the profit is minus 10. End of the year, profit is 90,000. So meaning the profit earned during the year is 1 lakh. If this 1 lakh has to be split between pre-acquisition period and post-acquisition period. April to September is pre, October to March is post. So pre is 6 months, post is 6 months, it will be split 50-50. So for the post-acquisition period, profits will be 50,000. And for the pre, it will be 40. Why? It will be 50,000 profit and 10,000 loss. So together it becomes 40. So I hope you understood this part. Yes? Now, this pre-acquisition of 30 and pre-acquisition of 40, together I can say pre-acquisition reserve is 70. Post-acquisition of 0, post-acquisition of 50, together I can say post-acquisition is 50. This will be split between holding and minority in 75% 25% ratio, what we arrived at in here, 75 and 25. Yeah? When I split that, I would get 52,500, 17,500, 37,500 and 12,500. Yeah? So now I'll take the totals. Total money that belongs to White Limited is 90 from the reserves. Total that belongs to minority is 30,000 from this reserves. Yeah? I'll mark this entire thing yellow, stating that we've done it. Now, this 30,000 what belongs to minority will come in minority interest. Here only see 17,500, 12,500, 1,05,000. That is because of taking this share capital also of 1,05,000. Here we have categories, no? 75,000 minority. So I have taken that 75, 17,500 and 17,500. So total minority interest portion comes to 1,05,000. Got it? So let's go to balance sheet also. And in my balance sheet also, I will mark my minority interest. 1,05,000. We've understood that. We've also understood our share capital of 6,50,000. Yeah. So now what we did is that holding company's share is there, no? Whatever is as a part of our pre-acquisition reserves. This 52,500. This 52,500 would not go to reserves and surplus. It will be adjusted against cost of control. So what is cost of control? Cost of control comes here. This nominal value of investments 2,25,000 would come here, and this would be compared with the book value of the investments that is there in the balance sheet. In the balance sheet here, we have investment made in the subsidiary 2,70,000. This is the amount invested. But the nominal value of it is 2,50,000. For a shares of nominal value 2,50,000, if we paid 2,70,000, we have paid more. That excess what we paid is goodwill of 45,000. But because we paid such excess money, we've got some capital profits, 52,500. This capital profit 52,500 comes from here, pre-acquisition reserves. So 52,500 done. So 45,000 goodwill, 52,500. If I take capital reserve, I'll get capital reserve of 77,500. This 7,500 capital reserve will go to notes to accounts in reserves and surplus. Yeah, in reserves and surplus, I'll write 7,500. And this, my friends, is revenue reserve from that computation. Have a look, revenue reserve here, 37,500. This revenue reserve of 37,500 gets posted there. Minority, we take pre and post both at one place. However, with regard to holding company, the pre-acquisition reserves will be taken and adjusted against cost of control or investments to find goodwill or capital reserve. On the other hand, the post-acquisition reserves will be taken in reserves and surplus in normal computation of the rest of the reserves and surplus. Got it? So by this we are done with analysis, minority interest as well as cost of control. So now only thing left is writing all the assets in the same values. Hello. Let's see what is the next items in the balance sheet. The next items in balance sheet: trade payable 1,15,000 and 1,75,000. We will add them up together and then write. I'll do a separate note to account. Have a look. In my notes to accounts, I've done trade payables. See, 1,15,000 and 75,000 together become 1,90,000. So this 1,90,000 has been posted to balance sheet. Have a look. 1,90,000 balance sheet, trade payables. You understood this? Yes. Reserves and surplus also I hope done. Yeah, everything else is done. So till now everything else is done. Next item. Due to White Limited. This looks like mutual indebtedness. Have a look. 30,000 here, 36,000 here. So this has to be adjusted. For now, let's write this in the inner column. I'm going to say in the notes to account, I'll write C due to White Limited 30,000 just return. Yeah, it will not end up in balance sheet. Then assets, we can add 5,80,000 and 3,51,000 and write them together. In my notes to accounts, I've written property, plant and equipment. 5,80,000 and 3,51,000 together comes to 9,31,000. This 9,31,000 is ready to be posted to balance sheet. If we come to our balance sheet, we have property, plant and equipment, 9,31,000. Got it? Next item is shares we've already taken care of. Inventories 50 and 1,20,000. Let's write them in the notes to accounts. Come to notes to accounts. See here inventory 50 and 1,20,000. Total 1,70,000. This 1,70,000 will get posted to balance sheet also. Come to balance sheet. See inventory 1,70,000. Understood everyone? Then next, what do you have after that? Due from Black Limited. This 36,000 partly is to be adjusted with this 30,000. Excess 6,000 you will write. Yeah. So 36,000 asset will remain because 30,000 is liability, 36,000 is asset. So firstly, what I will do is in this trade payable I will deduct that 30,000 here because that is the extent it's possible. And on the asset side, what will I write? It will be initially 36. I will deduct 30,000 mutual indebtedness. So what remains is 6,000. What remains is 6,000 should have been there. There is some adjustment. There is cash in transit. So I'll adjust that. So for now, 36 is what I start with. I deduct 30 from my assets and the same 30 from my liabilities. Done. Then we have cash and cash equivalent 39 and 54. So I'll take that 39 and 54. I'll add them. It comes to 93. There is some cash in transit adjustment. So after we adjust that, we'll identify the closing balance and then post. Done. So coming down to adjustments during the year. 39,000 which is sold to private limited, 39,000 has been completed. Okay, so this is just that mutual indebtedness के लिए paper point. Then we have cash in transit, 6,000 was still in transit. So 6,000 you increase the cash, 6,000 you increase the receivable because 36,000 was receivable. 30,000 mutual indebtedness you wrote off. Balance 6,000 is sent by one. The other has not received. It's in transit. If it was not sent, it would have been cash. Now, the person who has sent has not recorded in cash because it's gone out. The person who supposed to receive was not recorded because it is not received. So one of them has to record. So what will we do? The 6,000 balance, whatever is there, is now settled because we've adjusted the 6,000 now. It is cash is sent by one to other, and cash will decrease from one, and then other may it's already included. So we'll deduct 6,000. That's it. 6,000 deducted here. 6,000 added in. Sorry, we add 6,000 in cash and cash equivalent. We deduct 6,000 from our assets. Receivable may we deduct because it is received. So our cash and cash equivalent will become 99. Receivable will become 0. This 99 I will post it to balance sheet now. Have a look. Come to the balance sheet. We have cash and cash equivalent 99,000. See, everything else in the balance sheet is ticked. If you go for the total, you will get 12 lakh. 12 lakh. That's how your consolidated balance sheet will tally. I hope you guys understood this part. Yeah. If you need a detailed session on consolidation in the technique which I solve, which I consider to be a very, very nice and easy technique, please do mention in the comments and then tell me whichever topic you need me to do some more videos and all on the future and or teach detailedly. I will definitely consider that and then come up with the videos on that topic in the very near future. Got it, guys? Yes. So we finished 3A. Let's now go to 3B. There is a sub question because 3A was a 15 marker question, not a 20 marker question. Have a look. So 3A is done. 15 marks consolidated balance sheet. Very easy problem. No much adjustment, no unrealized profit adjustment, no updation of balance sheet adjustment, and lot of other revaluation of assets could have come. Lot of other adjustments could have come, but they have not come. Very easy to do problem. Let's see 3B1, 3B2, both are from banking companies. Yeah, come on. What is the question on banking companies? They're asking write a short note on non-performing assets of banking company. We've discussed this in detail in our class. whenever a bank gives an advance, it can be classified into two categories: agricultural, non-agricultural. If the bank has given agricultural loan or advance, then such agricultural crop for which they have given can be a long duration crop or a short duration crop. Long duration crop is a crop which will take more than one agricultural season, more than 1 year as agricultural season. Short duration crop is lesser than a year as an crop season. If it is a long duration crop, if the interest is outstanding for more than one crop season, it is considered as a non-performing asset. For a short duration crop, if it is outstanding for more than two crop seasons. Do you get this? That's what we've discussed. For other than agricultural loans, what do? We see whether the interest is received in time. If the interest is received in time, it's not a performing asset. If the interest is due and not received up to 90 days, again okay, still a performing asset. However, if the interest is due and outstanding for a period longer than 90 days, and if you don't receive money, then it will become a non-performing asset. I hope you all have noted that. Let's quickly see the answer for the same. Question 3b. See, bank advances can be classified into agricultural purpose and other than agricultural purpose. If it is for agricultural purpose, it can be given for long duration crops or short duration crops. An agricultural advance is considered as NPA if interest is outstanding for one agricultural season for long duration crops and two agricultural seasons for short duration crops. What if it is bank advance other than agricultural produce? You see if the interest is received. If the interest is received, performing. If the interest is not received and outstanding but up to 90 days, still performing. But if the interest is outstanding for a period longer than 90 days, then it is non-performing. Have a look. So up to 90 days, fine. Beyond 90 days, it becomes non-performing. So this is the answer that you are expected to write for 5 marks. I'll give you a quick 30-second time for you to read the answer once if you would want to, or take a screenshot and pause and take screenshot if you want to. I'll take a sip of water and then we'll do 3b2. Yes guys, ready? We are now going to do 3b2. I hope you guys read through 3b1 and you are fine with the same. Even if in case you have any doubt, you can reach out to me, you can text me, you can drop a message, and definitely get back with the solution to the doubts that you have. Or maybe try and do a video on that topic next time. Yep. So we have D Bank, that's the name of the bank, provides you with the following information relating to two cash credits. One is account A and account B. Sanction limit is 4,500 crores and 3,200 crores. If the amount is withdrawn beyond the sanction limit, it will be NPA straight away. But in this case, they have not withdrawn beyond. Let's see if they have withdrawn beyond or not. Drawing power. Oh, sanction is 4,500, but the power is there only till 4,200 and 2,500. So amount withdrawn cannot exceed that. Amount outstanding 3,600 and 2,000. So amount withdrawn is within the limits. Amount withdrawn is within the drawing power, so not an issue. And total interest debited. So this is interest charged. This is interest charged. You can say this as expense. Interest charged is how much? 288 and 315. So this is the amount of interest that needs to be paid. This is the amount of interest that needs to be paid, that they need to pay. 288 rupees and 315 rupees is what they are supposed to pay. Very good. Total credits in the sense this is the payment. This is the amount that they paid. If you want, I'll type it down here for you. Interest charged by the bank to the account is this much. Interest paid is this much. Yeah, so let's get back. So 288 rupees interest is charged, 120 rupees interest is paid. So interest is outstanding. Here, 315 rupees interest is charged, 380 rupees is paid. You paid excess. Maybe the excess contribution is not necessarily towards interest. It is amount paid towards principal also. Or I can say here, amount paid. I can call this, instead of calling it interest paid, this is amount paid. So even if you don't repay interest, at least you need to pay the, if you don't repay the principal, at least you need to pay the interest. In this case, 288 rupees interest charge, 120 you paid. So principal is outstanding plus there is interest also outstanding. When the interest is outstanding, then it will become non-performing. However, in this case, account B may, 315 rupees interest charge. We have repaid 380. So that first 315 rupees will be adjusted against interest, and excess of 65 will be adjusted against principal. So principal is also repaid to an extent. So we don't have to worry. Chalo, they've asked state with reason whether the above cash credit accounts are NPA or not. Account A is an NPA, account 2 is not. Have a look at the answer. Sanction limit is 4,500 and 3,200. Drawing power is 4,500 and 4,200 and 2,500. Amount outstanding is 3,600 and 2,000. So is the amount outstanding within drawing power? Yes, in both the cases. Interest debited is 288 and 315. Credit, that is amount paid is 120 and 280. Is it an NPA? Yes, for account A, because interest all by itself is not paid. Is it an NPA for account B? No, it's not, because the amount is paid in excess of interest. So part of principal is also repaid. Yeah. So reason is your interest is outstanding, your interest is not outstanding. A very simple question for 5 marks. Yeah. Lottery, you can say. Abba. Yeah. If this kind of questions comes, what is it? Abba. Lottery. Huh? Congratulations, brother. Congratulations. Yeah. That's what you'll hear. Chalo. Let's get going. We now have question number 4A coming on your screen. So 4A and 4B is what we'll discuss. 4A, 4B. Yeah, 4A, 4B will be discussed in this video. This is with regard to partnership. First one is with regard to dissolution of firm, and the second part is designated partner. LLP theory question. Once we finish these two, that would be the end of this video. Then I'll see you in part 3, wherein we'll discuss solution to question number 5 and question number 6. So let's start the partnership question. Ajay, Vijay and Sanjay have been in partnership for years, number of years, sharing profits and loss in the ratio 7:7:4. Very good. As wholesale stationers running business in the name of AVS traders. On 31st of March 2021, it was found that some frauds were committed by Sanjay. Sanjay is like fraud. Paka 420. Sanjay has done some crime, some frauds, not crime, frauds, financial frauds within the organization. During the year 2021, okay, so it was decided to dissolve the partnership firm. At mutual consent, they dissolved. They have given the balance sheet. What have they given after that? They have given some information about how the assets are sold and how the liabilities are settled and everything. They want us to prepare realization account, cash account, and partners capital account. Chalo, let's do it. All the working notes should form part of your answer. Yeah, definitely. Don't worry, we'll do that. Let's start with. To start with, we'll transfer all the assets to realization account and all the liabilities also to realization. When you transfer all the assets have to be credited, realization account has to be debited. Journal entry is realization account debit to assets account. So in the realization ledger, assets will come on the debit side. And when you transfer the liabilities which have credit balance have to be now debited, and realization account has to be credited. Journal entry will be liabilities account debit to realization. So in realization account, it will come on the credit side as by assets, by liabilities. And partners capital will go to partners capital account. So will be our reserves and surplus going in there. Realization account, we will write the selling price of these assets, whatever the realizations received. And then that will go to cash account also. And we'll open one cash account. Cash balance will not be transferred to realization. Remember that. Then we'll identify realization profit or loss. That will be transferred to partners capital. Amount payable to partners, which is there as a balance and figure in partners capital account, or amount receivable from partners in the dissolution process, will match with the balancing figure in cash or bank. So that's how this ledgers will be closed. And once all the 3 ledgers are closed, this problem is done. Got it, everyone? Chalo. Let's quickly see the answers now. For 4A. To start with, building 1,90,000. See, building 1,90,000 rupees posted. I'll mark it yellow the moment I finish it. Yeah. So then we have inventory 1,30,000. I'll post this 1,30,000 inventory to realization account debit side. Then we have investments 50. Investments 50 transferred to realization. Then we have trade debtors 70. Ouch. Yeah, the alt button on my keyboard is not responding. Fine. So trade debtors written. Then there is cash and bank balance of 26,000. This cash and bank balance of 26, what do? We'll not write it here. We'll open a separate ledger called bank account. In that I'll write 2 balance brought down 26,000. Done. Very nice. Then we'll go to Sanjay's capital overdrawn 40,000. So this will appear in the capital account, but on the debit side as opening balance. This is like current account balance. So this is my partner's capital account, not realization. This is my partner's capital account. In this, if you observe, on the debit side, I've written balance brought down 40,000. Done. So then I'll go to capital account 1,80,000, 1,80,000, 3,60,000, Ajay and Vijay's capital. I'll write on the credit side 1,80,000, 1,80,000, Ajay and Vijay's capital. Done. Capitals are written. Next item, general reserve 36,000. This general reserve of 36 should be shared between all the partners in their old profit sharing ratio. 7:7:4. So I've written here general reserve 14, 14 and 8. This is sharing of 36,000 in 7:7:4 ratio. I'm not even telling you, just do that, it will come to this amount. I've written the exact computation also here. 36,000 into 7 by 18. 36,000 into 7 by 18. 36,000 into 7 by 18. That is 8,000, 14,000 and 14,000. I hope you all understood. By this we're done with reserves. Then trade creditors 80,000. This will appear in our realization account. Very good. Yeah. Which side? Credit side. I'll write 2 creditors 80,000. Observe. 2 trade creditors 80,000. Then we have bills payable 30,000. 2 bills payable 30,000. Understood? Very good. So by this balance sheet is done completely. Let's read what's given below balance sheet. Investments costing 8,000 are sold by Sanjay at 11,000 and the funds are transferred to his personal account. Oh, the sales was omitted from the firm's book. This is the fraud that he has done. Now we'll adjust it. What is it that we should do? Investments are sold for 8,000. Now come to realization account. Then the firm should have received money, but Sanjay has taken it home. It is like, no, the firm has to receive money against this investment. We will not write investment account credit any longer because it's already done. Now the credit has to be given to realization account. If the money was received by the firm, then we would have written cash account debit to realization. Because the money is taken by Sanjay, we will now write the entry Sanjay account debit to realization account. So I'll write Sanjay's capital and then investment 11,000. 11,000 is the value. Am I right? Yes. And in my Sanjay account, Sanjay's capital account, again on the debit I'll write 18,000 is there. That's because one more item also needs to be adjusted. Let's see the next adjustment. Come on. A check of rupees 7,000 received from trade debtors was not recorded in the books and was misappropriated by Sanjay. Some time ago we told, no, Sanjay did a fraud. The fraud that Sanjay did is this only. He took the check of 7,000 and he took the sale value of investments 11,000 with him. So he has to pay to the firm 11 plus 7, 18. So in the realization account we'll say recoverable from Sanjay 18. And this 18,000 we will basically debit it to his capital account. 18,000. I hope everyone understood this part. Going on, great, 2 adjustments done. Let's now see the third adjustment, or okay, those 2 are sub adjustments of Sanjay's frauds. Now I have the second main adjustment. A trade creditor agreed to take investments of book value of rupees 9,000 at 13. What you need to remember is, don't worry about this 9,000. Don't try to compute profit or loss on sale or adjustment or anything. Only think about 13,000. So 13,000 is the value of liability decreasing trade creditors, and that is the extent to which our investments will also decrease. You get this? So then what is the rest of the trade creditors happening? The rest of the trade creditors were paid off at a discount of 10%. Now, when an asset decreases and liability decreases, we debit the liability, credit the asset. Technically speaking, in this case, our entry for accounting should have been creditors account debit to investment account. I hope you all agree. But we don't have creditors account, we don't have investment account. Why? Both of them are closed by transfer to realization. If I try to write entry for that 13,000, it will be realization account debit to realization account. Sir, 13,000 is the liability decrease, 9,000 is asset decrease, sir. 4,000 profit, that 4,000 profit also should be written to realization. So we will not write any entry for this 13,000 and 9,000. Oh, oopsie doopsie. What do we do? Total creditors will deduct 13,000. On the balance money, a 10% discount we pay. So now come here, how much is the creditors? If you observe carefully, creditors is 80,000. Against 80,000, 13,000 is already decreased. So I will take 80,000 minus 13,000. 13,000 they have agreed investment value. Balance is 67,000. and on the 67,000 they are giving us 10% discount. I'll do minus 10%. So I pay 60,300 rupees actually for balance settlement to creditors. Got it? That's what I've done here. Observe 90% of creditors. 90%. 90% is basically 10% minus. So 80,000 minus 10% minus 13,000 into 90%. Because 10% is discount, we pay 90%. That's what I was telling. 60,300 is what we get. So we basically end up paying 60,300. Got it? So if you pay 60,300, our bank balance decreases by 6,300. So in my bank account on the credit side, I'll write 6,300. Have I not written? How come? There is something more also. Bills payable payment. Together I've written 89,800 here. Not written 89,800. I think there is one more item. I've written these two together. Let's wait. So till here we understood. Then the next adjustment, the other assets were realized as follows. Inventory 1,20,000. So inventory realized 1,20,000 rupees for us. Fantastic. Building 110% of book value. Book value of building is 1,90,000. So we'll do 1,90,000 into 10%. 1,90,000 to 110%. That's what we did. Yes, how much is 1,90,000 into 10? 110%. See this? 1,19,000. Sorry. 1,90,000 into 110%. We get, ouch, 1 lakh. Less 10%. That is 2,09,000. Yeah. So 2,09,000 is the selling price. I'll write that. Got it? So then they're telling investments, rest of the investments. 9,000 worth investments are taken. No. We had investments worth 50,000. In that 9,000 worth investments are taken for 13. Balance 41,000. What's happening? They're telling balance investments are sold for 7,000. So 41,000 sold for 7. Don't try to affect for profit or loss and all here. Straight away rate what is the value? How much? 7,000 is the selling price. Just write 7,000. Right? Sold at a profit of 7. Oopsie doopsie. Sorry. Investments are 50. How much value of investments are taken over? 9,000. So it will be 40,000 minus 9,000. 31,000. Am I right? Investments of book value 9,000 has been taken over. Total investments is 50. 50 means a 9 gone. 41. They've sold it at a profit of 7,000. Is there any more adjustment? No. So 50,000 minus 9,000 plus 7,000. That comes to 48,000. 48,000 should be the value of investments. Oopsie, I've done it wrong here. Have I? I think yes, I've done it wrong. Let me correct this. $50,000 minus 9,000. Whatever is balance is sold at a profit of 7,000 plus 7,000. Let me type it again. 50,000 minus 9,000 plus 7,000. This is 700. I'll delete. Club this. Yo, how much will it come? 50 plus 50 minus 9 is 41. 41 plus 7, 48,000. 48,000 is our investment, and let's mark that yellow. Got it? Done. Then what else do we have? Trade debtors. Rest of the trade debtors were realized at a discount of 10%. So how much is the rest of the trade debtors? Trade debtors was 70. Is there any part of the debtors adjusted? Yes, it was adjusted. How was it adjusted? There is some amount ke liye check received, no? 7,000 rupees check was received. Oh, investment is 8,000. Investments costing 8,000 were sold. Oh, there is minus 8 here also. There is one more, minus 8 here. Once they sold 9,000 worth investments, once they sold 8,000 worth investments. So this becomes 40. 40 is actually correct. Yeah, they had 50,000 worth investments. First they sold 8,000, then they sold 9. So 8 plus 9, how much is that? 50,000 minus 8,000 minus 9,000. 33 is there. There is 7,000 rupees profit on the sale of that. 40,000 is realized. There are two sales. One sold to outsiders, one taken over by creditors to an extent. Yeah, I had forgotten the date. Yeah, investments 40,000 is correct. The point is I didn't write that detailed explanation. That's where all this problem happened. Yeah. So then debtors. Debtors is how much? Debtors was 70,000, of which check is received for 7,000. So we'll write here 70,000 minus check received is for 7,000, and they're telling the balance debtors are settled at what value? Are settled at 10% discount. Okay, let's do this and do minus 10%. So out of 70, if you have received 7,000, what remains is 63,000. Yeah, 63,000. From 63,000, if I deduct 10%, I'll be left with 56,700. That is the amount that will be paid. 56,700. And if we take the total of this, how much do we get? Total is only till here. Let me edit this. 40410. Yes, 4,25,700 is the amount received. This 4,25,700 I should write debit in my bank account. Aja. I'll write here realization account. How much? 4,25,700. Here. Have a look. Realization account 4,25,700. Got it? And then here payment is how much in that case? Payment we've still not done. Bills payable are to be settled at 500 at a discount of 500. How much is bills payable? 30,000. We pay 500 rupees less, so we pay 29,500. Got it? We pay 500 rupees less, so 29,500. Together it comes to 89,800. That is 6,300 paid to creditors and 29,500 paid to bills payable. Then there is adjustment which says that 7,000 rupees is a realization. Find out that realization from Sanjay's private assets would be 7,000. We are recovering money from him. No. He can pay 7,000. Okay, let that be. Yeah, is there realization expenses? 8,060 realization expenses. We'll write realization expenses 8,060. So together 89,800 and 8,060 is the amount paid in the process of realization. Together it comes to how much? 98,860 or something. That has to be written in bank account credit. 97,860. Not 98, but 97,860 realization account credit. In our bank account my credit side. Amount going out. Yeah, then that's it. The rest of the problem is over. Let's just go finish our capital account. Before that, in our realization account, we find the balance sheet figure, that is realization profit or loss. Once we find this realization profit or loss in the total, it will be split between the partners in the same ratio, that is 7:4. What is the ratio that we had? something 7:4, that ratio. This 6,160, 6,160 and 3,520. We'll give it to all the partners in their capital account, 6,160, 6,160, 3,520. Got it? Now, we'll see the balances. Sanjay has 8,000 plus 3,520 in his account. So, but he has to pay 40 plus 18, 58. 58. Credit side, debit side, the total is more. So, there is negative balance in his account. Sanjay has to bring in money, but he can bring in only 7,000. That is what was told in the question. He can only bring in, by sale of his private assets, he can only bring in 7,000 rupees. Balance has to be shared by other partners in their capital ratio. Garner versus Murray. See, he brings in 7,000 in the Sanjay account credit, in the capital account I'll write in the debit side. Yes. After that there is 39,480 which Sanjay should have still bought, but he will be not able to bring. We will mark that as our money that should be borne by the other partners, and this is where Garner versus Murray will come. The partners who doesn't have debit balance in their capital account should share such deficiency in the ratio of the capital just before the date of liquidation. Just before the date of liquidation, the capital is 1,80,000, 1,80,000 of Ajay and Vijay. It being equal, this 39,840 has to be borne by Ajay and Vijay in the same ratio. You got it? So the balance of the money, they would have to bring it into the firm to make it good. So much money they take home. So much money they take home. They would be taking more money if not for that loss of Sanjay. Now 1,80,420, 1,80,420 they'll take home. Balance in the capital account if I rate 1,80,420, 1,80,420, 368.40 will become the total, and our bank balance also will tally. Yes, so that ends our realization account, partners capital account, as well as our realization, as well as our bank. Everything else is done. Everything is in yellow. Done. So I actually got request from the previous sessions when I did the marathon revision. Students asked me to do a session on Garner versus Murray exclusively. So I'm planning that. Would be doing that very soon. It will be coming in the same YouTube channel where you're watching this particular video right now. So please do subscribe to this YouTube channel and then stay tuned. You will definitely receive an update about a video on Garner versus Murray. It is not going to be just a problem based one. I'm going to tell you the entire concept, who is Garner, who is Murray, how did the case arise, what was the original case about. Yeah, I'm going to bring in 2 new characters and explain it to you throughout completely about the Garner versus Murray case. So stay tuned to learn that particular case. It will come up on the same YouTube channel where you're watching this. And if you want video on any other topic of your syllabus that's bothering you, please feel free, drop it in the comment section or write a message to me and then tell me that you would need a video on that topic and I would definitely come. Yep. So let's now do the second part of question number 4, that is 4B. Explain the nature of limited liability partnership and who can be a designate partner, what are their liabilities. Yeah. So the nature or the characteristic features of limited liability is similar to that of a company. It is a body corporate, there is separate legal entity, and there is limited liability to the partners. So these are the characteristic features of a limited liability partnership. And designated partner is such partner of an LLP who's been designated to be having responsibilities or being responsible for maintenance of books, audit of the company, and operations of the company as such. Like the director in the case of a company is designated partner in the case of partnership form. And this person should be a resident, and it should not be a body corporate. It should be a natural person. It should be a resident and a person. So why does this come? Because in a limited liability partnership, partners need not be humans. Partner need not be natural persons. Another partnership firm can become a partner in LLP. A company can become a partner in LLP. So in such case, what will happen? In such case, you need to note that there are minimum 2 designated partners which are humans. What if the number of partners in the firm, all of them or all of them except one are non-persons or non-humans? Then what will happen? Then such body corporates or partnership firm, whoever are there as a partner in LLP, they will nominate a person to become the designated partner in the firm. That's it. A simple theory question. 5 marks will be like this. That 5 marks question, the moment it comes, okay. Congratulations, brother. Congratulations. Lottery. Yeah. Not income tax. But this time it will be limited liability partnership. Theory question. Congratulations, brother. Congratulations. Yeah, that's how it works with regard to this question. Chalo. Question number 4B. What is it? Limited liability partnership. Have a look. Limited liability partnership is a form of organization incorporated under LLP Act 2008. Characteristics of limited liability partnership are as follows. It's a body corporate. It's a separate legal entity. Perpetual succession and limited liability. I didn't mention the same to you. As per Section 8 of Limited Liability Partnership Act 2008, designated partner is a partner responsible for all the acts to be done to comply with LLP Act, including filing returns, maintenance of books, everything. Further, he is liable for all penalties and all contraventions under this Act. Every LLP should have two individuals as designated partners. However, if all the partners or all the partners except one is other than an individual, then such body corporate should nominate a person as designated partner. See, every LLP to have two minimum individuals as designated partners, of which at least one of them to be resident partner. One of them should be resident also. However, if all partners or all except one are corporates, then the nominees of such body corporates can be designated partners. Very easy question with regard to question number 4. 4b. Yes, I would call it an end for this video right now, lecture number 2. And we will join again in lecture number 3, wherein we will discuss question number 5 and question number 6. Question number 5 and 6 will be 5 is on buyback, 6 is on again banking company, capital adequacy computation. Then we have one AS question, two AS questions, one on AS 17, one on AS 19. 19th one was a very tricky one, trust me, no one expected that. And then we have one on dissolution, one on differential rights, and then we have a small ESOP question at the end. Yeah, that's what you'll see in the part 3 video that's coming up little later. So see you all in that one. I hope this video 3rd and 4th had some value addition to your, what to say, preparation, or value addition to your you as a person and your knowledge base when it comes to accounting. Yeah, that's it, guys. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you guys are learning something, you're having fun, it's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple, it is to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? I really hope your answer is yes, we are in the game. See you all in the next one. Till then, tata, bye-bye, take care.